All right, welcome everybody. I am John Haig. I'm the co-director of the Mosava Rahmani Center for Business and Government. Welcome, and we have a terrific speaker today, Jean-Pierre Landau. Jean-Pierre has been a senior fellow and a research fellow at the center for a number of years now. This is part of ongoing work that he's done around digital currencies, central bank digital currencies, thinking broadly about this issue. I remember probably 4 years ago, you and I had a debate with Tim Masson about whether this was real or not. And I don't know if you know, Tim is also a senior fellow who was the head of the Commodity Futures Trading Commission. Jean-Pierre, just a little bit of background. He's an associate professor of economics at SciencesPo in Paris, one of the, maybe the best university in Paris, some would argue, and a senior official at the French Treasury and Central Bank. He served as the deputy governor of the Banque de France, executive director for France at the International Monetary Fund, the World Bank, and the European Bank for Reconstruction and Development. He was also Undersecretary at the Minister of Finance in Paris, member of the board of the Bank of International Settlements in Basel, a G7 and G20 deputy, and a member of the Financial Stability Board and its steering committee. So he's got this phenomenal background in kind of central banking and general banking. He was a visiting professor at Johns Hopkins. He's written with Markus Brunnermeier from Princeton, who's professor of finance at Princeton. Co-authored in that with Markus the Euro and the Battle of Ideas. He is here to talk to us today. As you can see, digital euro, digital dollar. Is there a case? So our debate and discussion that started 4 years ago is still ongoing. And I appreciate all of you being here. For all of you who are joining by Zoom, we had a large number of people register. You're welcome. We appreciate you joining virtually. I just have to tell you that by not showing up in person, you're missing a beautiful lunch in the back of the room, but we won't dwell on that for too long. And with that, I'm going to turn it over to Jean-Pierre, and thank you for coming.
Thank you very much, John, for having me. And it's been a real pleasure to be part of the Development Center, associated with the center for the last 3-4 years. It's been an intellectual pleasure. I was telling Dan it's permanent intellectual adrenaline, which is what I need at my old age. And so but extremely I'm very grateful to you for introducing this conversation. So, as John said, I've been almost addicted to the question of digital money for the last 5 years, 4 years. And this is an addiction that doesn't go away because there's always something happening, right? Most likely, as you saw, as a result of sanctions in Russia, people are rushing to cash. I read that the digital systems, currency systems have collapsed in Russia, digital payment system. So that has awakened me to a little bit attenuated my enthusiasm for the company. Still, we try to keep the balance of that. And the reason for that title is that you can see from recent statements or reports that central banks in the world are reacting a little bit differently to that question of digitalization. A lot of them are very dynamic, very proactive, especially in emerging economies and in advanced economies like Sweden, European Central Bank. And the Federal Reserve, and to a lesser extent UK, are perceived as less enthusiastic. And they may be thinking that there's not a case for moving the central bank into digital territory. So we're going to discuss that, and I'm very much in favor of moving central bank into digital currency, but I will try to present to you the pros and cons of the issue and have a discussion. And the very interesting thing about that, of course, is that there is a double dimension to the problem. There is a technological dimension to the problem, which fascinates a lot of people, maybe some developers, of science amongst you are fascinated by that. And there's a monetary dimension, which I found almost as fascinating, if not more fascinating, which very few people dig into with sufficient attention and I would say knowledge. There is that British-American comedian, you surely know John Oliver, who made a video about cryptocurrencies 4 years ago, and he said it's everything you don't understand about money, combined with everything you don't understand about computers. And that captures very well the double fascination that those animals, objects have on us. But just to start and to make it very simple, what's happening now is that we have the possibility of having digital cash. And that possibility, something which is cash, but is not material, right? And that possibility has been forecasted, foreshadowed by Milton Friedman, always a genius in monetary matters, who made that statement. You could find it on YouTube, which is very clear. You know, even before the mobile, I mean, the smartphone goes back to 2007. In 1999, Milton Friedman sort of foresaw what would happen, that we would be able to exchange over the internet digital objects, which are equivalent to cash. So if I had to, again, to sum up in a very short sentence, what's happening, we have digital cash. So it's exactly like cash. It should be exactly like cash, not exactly like cash, but it's exactly like cash. And apart from the fact that we don't have to be face-to-face to exchange it, there's no distance, there's no border. Everything is possible. So that is cash without the physical frictions, as monetary economists would say. So what is the technology behind that? I'm not going to spend much time on it, but it's very important. The main innovation is what people call the token. So the token is a digital object which has value and you can transfer over the internet. And to make it possible, you have to get a very secure cryptographic system which ensure that only you can access to the digital object and transfer it. So I'm not going to dwell too much into the technicalities, but sometimes this fantastic innovation, which is the digital token, has been overlooked. And the reason it has been overlooked is that people are focusing on the second innovation, which is the ledger. So you heard a lot about the IP on the blockchain, the ledger. And of course, the digital object has to be recorded somewhere. So it has to exist on a ledger. But in my view, there's been too much attention on the ledger. The blockchain, the DLT are very interesting technologies. But the main innovation, the main progress is our ability to attach value to something that does not exist materially and transfer it over. And it's an object. It's not an account. It's very different. You can live without, in theory, you could live without accounts, meaning you can live without banks. If we all live in a world of digital cash, that is, in theory, what could happen. We have a lot of cash in our digital cash in our mobile, move it around, transfer it to virtual money market and control it. You don't need an account. It's an object, very important. And of course,
we're having a request from the folks on Zoom for you to speak up a little.
Speak up a little, like this. Yeah, sorry about that.
No.
Yeah. And of course, backed to that very diversified technical infrastructure, you can have different monetary architecture. So I'm not going to develop them right now, but also speaking, there are 3 types of digital money which coexist today in our world. The first one is just a reflection of your bank account. So the token is there, but it's just there for you as a debit or credit card. You can use it to mobilize and transfer your bank account. That's called open banking. The second one is, you heard about it, are stable coins, which are digital tokens backed by some assets, diversity of assets. And the third one is cryptocurrencies, which exist by themselves in their own unit of account, moving on and backed by nothing. So these are the 3 types of monetary architecture, and they are very different in their monetary implications. And we won't discuss them in detail today, but I can answer any question. I will try and answer any question that you may have on those. So behind the technology is there. Everybody recognizes the technology. And what we have seen over the last 3-4 months is a sort of a split in the way people react to the technology. Right? So you have in this country in particular, people who say, okay, we have a huge technological innovation in payments. Retail payments are changing. It's just that. It's a change in retail payment. So the policy objective is just to adjust our regulatory system and our oversized system to that gigantic progress in technological payments. Right? And those people are very well represented in the Federal Reserve. I have a speech of the Governor Waller, who said 6 months ago that the CBDC, central bank digital currency, were a solution in search of a problem. And that title was almost duplicated word by word on a recent report by the House of Lords in London. We don't need them. There's no problem. Why would we need them? And Governor Quayle, of course, went even further, comparing the fad about CBDC to the fad about parachute pants, which apparently seized the world in the 1980s, and everybody had pants which mimicked parachutes. So this is a little bit dismissive. You understand, those people don't think there is any kind of a problem. And it's a problem of payment. And in the academic community in this country, I'm sure it's a lot of people around here or in the economics department, you'll find a lot of, and Chicago, the finance department, you'll find a lot of people all of that. So we have a revolution in payment. We're going to deal with it. Good. By the way, having retail payments easier, cross-border, financial inclusion, all this is good. We don't need anything more than we have. And then you have a second school of thought, of which I rather belong, which is more than that. It's more than a change in payment, it's a change in money. And because it's a change in money, it challenges, and that's what I find fascinating, it challenges our approach to money, it challenges our conception of money, and it requires that the central bank embrace that technological change and issue their own digital money. So I'm going to try and develop a little bit why I think that view is more appropriate for judging the situation. Not being 100% sure. I'm 90% sure, but I still have a doubt in my mind, and I will mention that doubt when time comes. So there are at least, I would say, four reasons why I think we are facing more than a change in payment, but actually a change in money. First, and those four reasons have a common cause. The common cause now is that everybody can create money. Any smart developer can create a digital currency. That's easy for a smart developer. There are thousands of smart developers all over the world, so everybody can create money. That's the reason why you have 1,600 cryptocurrencies and counting. Right? Everybody can. Now, whether, as Minsky said, it's easy to create money, the problem is to get it accepted, but it's getting easier to get it accepted. It's just like a video game. You launch something on the internet, and if you're lucky and attractive, thousands of people start to use it. You have the network effects, and it works. So now that we know it's easy to create money, what are the consequences? What are the consequences? Not in the world. In the world, note that in the world we are in right now, before the digital, it's not easy to create money. You have to be a bank, you have to be licensed, you have to be regulated. You cannot create money like that overnight. And if you want to benefit from the network effect, you have to be part of a network of banks. So there is a change. The fact that there is a technical ability for everyone to create money is a big change. What does it mean? First thing, you can do a lot of things. In theory, you can be very diverse. And the trend or the fad, and I've discussed that with friends or colleagues who are involved in the IT of banks, is to do what they call programmable money. So programmable money is the digital money you may have on your mobile, but it can be used under certain circumstances. So the one thing which a lot of people find very attractive is, for instance, you go back 1.5 years ago, you had the COVID pandemic, you had a system of welfare payments. You want to send the welfare payments to the people who need it. We are most likely poor people. A great proportion of them are unbanked, but they have mobile, right? So you're very happy to send them the money through mobile application immediately. And in addition, that was the problem 2 years ago, you don't want the recession to deepen, so you want them to spend the money immediately. So if you're able to do whatever you like with the digital object, you would make it programmable, and you would say, if the money is not spent by May 21st, it's void, it's nullified. So people have to spend it. Okay? So that's a very attractive way, even from a public policy perspective, to use digitalization of money, because you send the money directly to the people, and it's much easier to identify them by their phone number than by their bank account, and they have to spend it. I'm not in favor of that, and I'll tell you in a minute for why. But it's an attractive proposition. If you're a little bit more paternalistic, if you're a paternalistic government, you would say, okay, I'm going to send you your welfare payments, but the money will be such that you cannot spend it for alcohol, you cannot spend it for the movie, you can only spend it for a certain usage, a certain number of usages. Closer to a food stamp. So you can have a diversity of intermediary formula, which makes more or less money. So that's very attractive for people. Another thing you can do is to write what they call smart contracts. So you have the smart contract prospering on the blockchain, and that's a programmable payment. That's not a programmable money. So the monetary unit itself is untouched, but the condition under which the payment occurs is governed by an algorithm. All this is possible. So for me, the fact that you can issue money which is half money, half food stamp, already is a big change. It's a change in the nature of money, and I'll explain in a minute why. Second, of course, if everybody can create money, there will be stronger monetary competition that comes from domestic. I'll say a few words about Libra in a minute. Libra was not allowed to prosper. You know, Libra was the big currency created by Facebook. But if Libra had been allowed to prosper, even economies such as the euro area or the US would have been exposed to currency competition by a new money, which will be governed by a big international company with 2 billion potential users. So that's currency competition in its rawest form. And that's the reason why it was not allowed to prosper. So you can have competition, stable coins, may be prospering. And if you are a middle-sized emerging economy, you are exposed to digital currency competition by people issuing money in digital form that your citizens may want to use. Right? I say middle-sized because if you're small size, very small size, monetary autonomy doesn't mean much for you. If you're big size, you are the originator of competition. But if you have middle size, you want to have monetary autonomy. You're big enough to want to have monetary autonomy, and you're still exposed to currency competition. So it's no coincidence, in my view, that those countries which have been more interested in issuing central bank digital currencies are emerging economies of middle size, right? Like Uruguay, Indonesia, Philippines, all these countries. Third, of course, and I won't develop that much, but it's obvious. We can see that those big stable coins or those big new monetary objects are issued by people who tend to be giant big tech companies and platforms. So they use the issuance of money to comfort and strengthen network effects and lock-in effects inside their platforms, right? And so they have a huge incentive to make this as a closed system. I still remember it was sort of an awakening for me 3 years ago when I read an interview in The Guardians. I could send you the quotes if you like, by a gentleman who was one of the leaders of Tencent, unfinancial, the big Chinese company who basically are issuing their own money, although it's already maybe convertible. And he was saying, our ideal is that people spend their life on our platform, right? So sort of closed ecosystem. And of course, and that was the idea behind it. Well, okay. So that means the monetary system is going to be segmented across platforms. We call that with Markus Brunnermeier digital currency areas, as opposed to ordinary currency areas. And they will be cross-border. And they will have a territory or jurisdictions which will be private and which will not coincide with national borders. It's segmentation, competition, segmentation. That is the two main drivers of the new digital money world. And last but not least, public money will disappear. So there are two forms of public money. Part of public money will disappear. There are two forms of public money in our economies. There are bank reserves, which are reserves held in accounts of the central bank, which used to be money, moving money around between banks. And there is cash. Cash is the only public money to which we have access as citizens. So the day cash disappears, we enter a world where, as citizens, we only have access to private money, which some people tend to consider as benign. And all the people I talk to you consider either unlikely or as benign. But I don't, and I think it has never happened in the history. I cannot think of a situation in the last 400 years where the citizen did not have access to public money. So maybe history is just not a good guide in these circumstances. We're going to reflect upon it, but it's important to remember that. So is public money important to the economy? And I think this is a theoretical, basic question that we have to face when you think about central bank digital currency. And then, of course, I cannot resist to have this basic fundamental question: what is money? What is money? And the one thing which characterizes money, that it is acceptable unconditionally at its nominal face value by everybody. And so this is money. Everything whose value changes over time in nominal terms, or is subject to some kind of contingency, programmation, algorithm function, is not money. It's a financial asset. The difference between money and a financial asset is that money does not change in nominal value. So you can immediately see that the two trends which I mentioned, which are segmentation and variability, programmability, are a threat to the nature of money, same of the nature itself of money, because they could change the value of money over time. The second very important concept is the key property of a monetary area, which is uniform currency. Uniform currency has disappeared from our monetary language recently, over the last 40 years. But when you go back to the whole Fed literature in the 50s and even the 70s, uniformity of currency was considered as something very important. Now we take it for granted. We take it for granted that the dollar deposited in the bank in Boston is the same as the dollar deposited in the bank in California. The same. The currency, and they are both dollars and they're equivalent to $1 in cash. Well, for those of you who know monetary history, they know that hasn't been the case until 1920. It's a very recent conquest, and it's a very recent achievement by central banks to have a uniform currency. Very, and it makes everything more easier. Of course, if I have a banknote or a deposit account, which I'm not sure its value, then I have to enter into a very big, cumbersome information gathering process, which create a lot of frictions that precisely money is here to avoid and to suppress. So uniformity in money is very important. We tend to take it for granted. We cannot take it for granted in the digital world. Because as I said, all the operators of the digital world have an incentive and a tendency and a technical capacity to diversify the form of money and to create segmented monetary systems. So uniformity of money is not something we should take for granted. And how is uniformity of money can be achieved? And that's where I think at the deep level, theoretical level, people differ. I guess the first school who think we could deal without a central bank digital currency would say we can ensure uniformity of money for regulation and supervision. We can ensure for regulation and supervision that a deposit in Boston and a deposit in Alaska are exactly the same unconditional. That can be done. And I would argue that I'm not so sure. So that's where, that's where we need more research, actually. I'm not so sure. And at the moment, you may not be aware of it, but the one thing which makes you trust your bank deposit ultimately is that you have that feeling that you can convert it into cash. So that's what I have called. I mean, this is the term I'm using it, so it's not a sort of accepted term. This is a subliminal role of cash. We don't use it, but it's there. We don't think of converting our deposit account to cash, public money, but we know we can. And the day we are not sure, we run. Look at what's happening in Moscow. Right? The day we are not sure that we can convert it into cash, we run. So public money still plays an enormous role. And I would submit that the convertibility of private into public money is what allows us to have a uniform currency. And so if we are in a digital world where you cannot convert into public money because there's no public money, cash has disappeared, then you have a problem, and you have to come up with a form of digital money which is public, and that's the purpose of a digital euro or a digital dollar. Now, the second question you ask is what is monetary sovereignty? It's a big word. It's a big ambition, and we seldom sort of explain and explicit what its content is. So usually, for those of you who do international economics, is dealt with the problem of capital movement. So if you have capital account convertibility, capital account open, mobility, capital mobility, monetary sovereignty is important. So we all see that. But again, something we take for granted, which is the unit of account. So monetary sovereignty is the ability to conduct monetary policy. And to conduct monetary policy, you have to control, be able to influence the evolution of prices in your unit of account. So to control, to be independent and sovereign in money, people have to use your unit of account in their day-to-day dealing. They have to use that to set their wages, to set their prices, to denominate their debt contracts. Then, of course, when you move up interest rates, all those transactions which are denominated in unit of account are affected. But let's say you are, and the word has been frequently used, dollarized. If you're dollarized, if you like Turkey, for instance, Turkey has 60% of its economy in dollar. If you dollarize, when you move up and down the interest rates in the Turkish lira, it only affects 40% of your economy. The rest will react to the US monetary policy. And of course, what we are facing with is the possibility of digital dollarization for an enormous amount of countries, because it's very easy for any citizen to access digital currency unless you put a very, very strict barrier like the Chinese firewall. Otherwise, you can access digital money. So you can be digitally dollarized or euroized or renminbiized very easily. And then once you have a significant part of your population which counts and contracts and gets indebted in foreign currency, you've lost your monetary sovereignty. So there's a big question of monetary sovereignty there. And of course, although we are not aware of it, we live in this country, in the euro area, we live in a country where nobody really challenges the unit of account. Nobody really does that, right? And so we have a unit of account. The unit of account, how do you define ultimately a dollar? A dollar is a liability of $1 in the balance sheet of the Federal Reserve. And everything goes from that. $1 in the balance sheet of the Federal Reserve. Then you have the bank accounts, which are exactly equivalent to the $1 in the balance sheet of the Federal Reserve by convertibility and by lender of last resort and everything. And then you have the bank, and everybody uses that. But I've heard some friends told me that some people who have accounts in China, in Tencent or Financial, when they go to a Chinese restaurant in the US, so it's anecdotal, you know, but they pay in renminbi from their wallet in China. And which is more important, the meal is invoiced in renminbi. There's a little bit, very small piece of renminbization in the US. But you can imagine if you're a medium-sized country, and you can imagine what would have happened if Libra prospered. So Libra was an extremely ambitious project, which its own unit of account, 1 Libra, based on a basket of currency. It was sort of private SDR, right? Which would have been accepted by 2 billion people, all the people who are who are on Facebook, and which have been totally cross-border, and whose impact on the monetary sovereignty of the country was totally unknown. So Libra was killed. It was killed by 1,000 deaths, 1,000 regulatory measures to make it practical. And the reason why it was regulated away is that people, central banks knew, they never mentioned it, politicians did, but central banks never mentioned that it was a direct threat to the monetary system. Direct threat. And there was some kind of new governor for new central bank, Markus, and that was really, really unacceptable. So this question of the monetary sovereignty is, of course, technically very important, unit of account. So to avoid that, of course, to ensure the uniformity of currency and to protect the unit of account, you just have to duplicate in the digital world the kind of arrangement that you have in the digital world, which is issue a central bank digital currency, a public cash available. So let's say you decide to do that. What kind of policy issues are you facing? I will mention them very briefly. In our report with Markus for the digital euro, you develop that enormously. But there are three things which are interesting to just have a look at and have a projection. The first one, of course, is the disintermediation, possible disintermediation of banks. So if you and I, we have the possibility of holding on our smartphone either a token which is a claim on the bank or a token which is a claim on the central bank, the liability of the central bank, we will choose the latter because it's safer, it's like cash, right? So there is a risk for the bank that there will be disintermediation. And there are two kinds of risk, that there will be structurally, there is kind of structural shift that people will take their money once the digital dollar or the digital euro is introduced, take their money out from the bank and put it into the digital currency, official currency, and also in case of one, if you have reason not to trust the bank, you can move much faster. These are serious issues. That makes the banking community very reluctant to the idea of CBDC, both in this country and in Europe. These are not without solution, and it should not be overemphasized. Should not be overemphasized. In my view, the main threat for the banks come from the stable coins, the digital money, and all the possibilities that big tech will have to issue money, which would be comparable to bank money. So the question here is, what is the main source of competition for the bank? Is it the public or is it other private actors? And that can be debated. And of course, the answer to that question will also depend on regulation. So this is a complex question. I can develop it in answering questions. Complex issue, I can develop it in answering questions. The concern is real. It should not be, in my view, overemphasized. Second, the role of central banks. As we all know, one of the major evolutions in the last decade is that central banks have grown from having very, very small balance sheets. You would not believe the size of the Fed balance sheet in 2007, 50 billion. Now it's 7 trillion, 8 trillion. Huge expansion of the balance sheet. And of course, if people move to digital money coming from bank, the size of the balance sheet can be increased. And there are two possibilities for the central banks of issuing digital money. The first one is to open account to every US citizen. The Fed could now technically open an account to every US citizen. That would be technically feasible. That would, in my view, and I think everybody's view, totally inappropriate. It's not a commercial bank. They are not equipped, nor should they be, to deal with all the issues relating to relationship with consumers, know your customers, money laundering, security, and so on. They don't have to provide a commercial service. So I'm very confident that nobody will do that. But the other is to issue digital cash in the form of tokens, and most will do that. So even then, their balance sheet could increase, which I would not go into technicalities, but they would have to refinance the bank more. So central banks will find themselves with a bigger role in financial intermediation, which may not be something you want into a market-based economy. So that's the question. Second question. And the first question is about privacy. So privacy, of course. And when I said digital cash is like cash, with one exception. Privacy, precisely. Many exceptions. One of them is privacy. When I have cash, cash is private by nature. And if I want to control cash from good policy reason, I have to create specific legislation, AML, anti-terrorist financing. Now, for digital cash, it's very good. Digital cash is unprivate by nature. And if I want to make it private, I have to create specific safeguards inside the system and embed them into the system. But there's a total asymmetry there between cash and digital cash. And I think if one day central bank digital currency see the day, the question of privacy is going to be a major one. And I mean, in academic setting, I can say that I'm not totally confident that the central banks have perceived the sensitivity of the topic. And I think there is a general feeling that people don't care that much about privacy in the digital world anymore. And so they don't care about privacy in money and payments anymore. And so we should give them a minimum privacy, but not too much. I think it's a major question for citizenship. And that is going to be heavily debated when we come back to the implementation. So to sum up, I think if I want to sum up the sort of position that can be taken on this issue, whether a digital dollar is necessary or unnecessary, I would sort of underline three questions. Will cash disappear or not? And here, of course, what's been happening in the last 10 days makes me nuance my opinion. Digital money needs infrastructure. It needs electricity. It needs things working. Right? And so when you are in a situation of war, invasion, whatever, you're not sure. The cash may be king in those circumstances. And I think, in all honesty, what's happening now should make us think very hard whether the disappearance of cash is something we want to condone. It may be outdated. I remember Jack Ma saying, cash is obsolete. We want to make it obsolete. Whether that's true in any circumstance. You cannot be sure of anything about it. You really have to keep thinking all the time. Right? So, first dimension, will cash disappear? Second dimension, is there a threat of external and internal competition? And third dimension, can I trust regulation only to ensure the uniformity of currency, which is something that everybody wants to do. So if you are skeptical, if you think that these are parachute plans, this idea of digital central bank currencies, you would say, no, cash is not going to disappear. And I think part of the position of the Federal Reserve today is due to the fact that they don't think cash will disappear at all. People will still want to hold dollar notes for almost infinite period of time. Is there a threat of external or internal competition? No, I don't think the US think they can be threatened by stable coins or whatever. They have the regulatory power for that. And will regulation therefore suffice? Yes. So if you have that set of answers to those three fundamental questions, you don't think that public digital currency is necessary. On the contrary, if you think cash may disappear, if you think that you will be exposed as to domestic or international competition, and if you think regulation will not be enough, then you are in favor of central banks pursuing digital currency. So we're entering a very interesting period of thinking about that, deep policy issues. I don't expect things to be moving very fast. I think now everybody has launched projects, everybody's studying, all central banks are trying to step up to the issue. I don't expect them to be moving very fast, especially again with the war and invasion, but it's going to be with us, and we may be in those periods where technology actually changes totally the nature of our monetary arrangements. So it's very important to keep observing it, to always try to relate to the fundamental theory, understand the technology to the extent it's necessary, but at the end of the day, what will allow you to make a judgment is a sort of good knowledge or this perception of. Thank you very much.
Jean-Pierre stayed on time. Jean-Pierre loves to talk, and sometimes it goes a little longer. We're going to open it up to questions. It's nice to see my PA students here. So we'll open it up to questions. I'm going to start, I'm going to use the prerogative of the chair. I do have one question. Well, I had a lot of questions, but one is a starting point, and it's the definition of digital, basically digital money versus cash. And I've always thought of money, you know, when you read your macroeconomics text, right? It talks about the 3 dimensions of money. And one dimension is money as a store of value, right? So you can hold money and it enables you to have money today and buy something in the future, right? The second is a kind of unit of account, right? So it's a way to keep score, kind of, if you will. And the third is as a medium of exchange, right? So money enables you, you know, if you want to buy a bed, you don't have to show up and find somebody that has, you know, has a bed and they want to buy whatever you have, like a car, right? You don't have to barter, right? So it's a medium of exchange. And it's not clear to me, like fiat currencies by themselves don't have value, but they are money. But they are backed by the full faith and credit of the issuing government as a fiat currency, right? And I'm not sure how that plays into your definition of digital currency, because if you have convertibility of the digital currency into some form of other money, if you will, then you've got a structure that seems to me like it could work. Now, there are a lot of other questions about private money and all the things you went through, but just kind of, can you help me think about the definition and this convertibility issue of digital currencies into other forms of currency, particularly government fiat currency?
Yeah. John, this is at the heart of the question. So, I'm very happy that you asked. So first, the 3 functions of money. So different people have different views of the hierarchy of those 3 functions. Right. So my view, as I made clear in the definition, is the medium of exchange function is the central function. If you cannot use it to pay, it's not money. Right. So that's very important. That's my definition. And that definition concludes lets me conclude that Bitcoin is not money, because you cannot use it to pay. That's right. And after that, of course, there is a big theoretical question, which I have thought a lot, very hard since I started this research. And it forces us to, and this is the question you asked, does that function of medium of exchange carries with it the unit of account, carries with it the store of value? Right. And on this, I'm not sure. Okay? So I would have expected, for instance, if Libra has seen the day, that progressively it would have been a medium of exchange, a unit of account, and progressively it would have become a store of value. People would have stored their savings in Libra. So I would think that something which is used massively as a medium of exchange becomes a little bit a store of value, and maybe one day unit of account. That's why the Chinese government sort of fell so hard on the regulation of unfinancial and Tencent, because you had 2 networks with tokens denominated unit of account in red rupees, but they were closed. They were closed, right? And so everybody knew Jack Ma. Nobody knew the head of the central bank. So there was a danger that progressively those monetary systems would evolve and fulfill more functions once they had totally achieved dominance in the medium of account. So that's the first part of your question. And the second part of your question is backing convertibility. That's an extremely important question. And I'm not over in my reflection on this. I'm actually trying to write a paper on that right now. And I would say again, there are 2 sub-questions of that. The first is that backing and convertibility are 2 different. And Tether, for instance, the stable coins plays admirably on this ambiguity. And Libra was playing on the ambiguity. Convertibility, I go to the bank or anywhere, or I click on my smartphone, and immediately I move to another form of money. Backing is different. I have the assets. I tell you that the assets are there to give value to the money, but if you want to access the assets, you have to give formalities, notice, and they can promise you. And so backing is very different from convertibility. And all our system you rightly say it's backed by the power of government. We'll come back to it in a minute. But all our system rests upon total convertibility of private into public right now. Nobody is going to ask you any questions if you go and draw money from an ATM. If you try to convert your tether or your circles into a bank deposit, it's going to take you some time. There will be friction. That's the difference between backing and convertibility. And in terms of trust, it makes the whole difference. So, and then you say it's backed by the power of the state. And this is the big question. At the moment, we accept money because it has legal tender, or it is exchangeable to something which has legal tender. So it's backed by the power of the state. Tomorrow, let's say again Libra or large, will we accept it as purely private because we know that on the same network there are 700 million people who are operating on that network. So will the network effects, which are gigantic of a digital economy, substitute to the power of the government? I don't know.
I think that's a huge issue.
That is behind your question.
Right. I mean,
if the answer is yes, then the whole question of medium of exchange becomes covered. The network could impose its own medium of exchange, and through that, they could impose their limit de facto and store of value. And I think that's what scares the government.
Yeah, I mean, this is a much longer question, and I want to make sure I give everybody a chance if they have questions. But the one thing I have to say is, so if let's say Libra had been successful and it hadn't been regulated, I think implicitly people are assuming that there is some kind of the equivalent of the full faith and credit of Facebook/Meta behind that currency. And that all of a sudden turns companies into entities acting like nation states, but not bound by normal national boundaries, right? They're operating in a digital universe in a global basis, like Tencent, your example of Tencent, you know, or Alipay, or kind of take your pick. I think that raises a big question in my mind of how is this going to play out? What are the regulatory responses that are likely to develop around? I don't want you to answer that because I want to give people.
I can comment on that because I think it is the core issue, right? And in my view, going a little bit beyond the monetary issue, companies which have a large network and which can play network effects have a normative power, independent of the state.
You'd like to call.
And a normative power which is independent of the state. So you can see, for instance, that today people who decide what is admissible as free speech or not are not the government. It's the companies which own the network. So the standard of speech is the norms for free speech and determined company. And the unit of account is a standard of value. It's no more than that. Okay, it's the equivalent in modern field that the yard or something. And so, yes, you're right. If in that universe, the standard of value may be determined by someone who is not the government.
Okay, I apologize for taking prerogative of the moderator, but yes.
Well, great minds think alike. Following up on that question, on the extraterritorial application of U.S. law through the dollar clearing mechanism, I think so. For example, in the Obama era, BNP Paribas received these massive fines, and was even this big issue, right? But I don't know, Fed wire system clears about 10 times global GDP last year. So it's kind of like the global bank, and the dollar clearing allows you to do essentially policy implementation. We had the HKS simulation. So I was wondering if you could offer a few comments on how we should think about this, particularly now that I think Russia is going to be banned from the SWIFT network, and it seems like this has a lot of bite. And so it seems that.
Will you allow me a sort of theoretical answer? Yeah, and it all goes down to what John said. So where do you get your scale effect? The money exists because a lot of people accept it, right? Otherwise, it doesn't exist. So there's a scale effect. And the scale effects in money, they can come from two different sources, which exactly the two functions that John mentioned. If it's a medium of exchange, the scale effect comes from the network effect. You can get in touch with a great number of people. And of course, in the digital world, borders do not matter. You can get, okay. So you have a basis for the valuation of money, which is the network effect. Now, for the dollar, some people, and actually eminent people like the chief economist of the IMF, would say this is exactly the same scale effect. So the dollar is used as a medium of exchange. I have, and I'm sorry to say, a different view on that. The scale effect of the dollar comes from its function as a store of value. Exactly what John mentioned. It's a reserve asset. It's the safest asset that you can. And so nobody in the world can have an economic life without the dollar. It's impossible. That's because everybody has a reserve on the dollar, needs to use dollar. And that's where the sanction power comes from. So you have, just to put it into, I made a video on that. I could send it to you. I made a video on that. And money is about scale. Scale can come either from network or from liquidity. And actually, that liquidity is the dollar. And depending on where your scale comes from, you have very different vision of the future of the international monetary system. If scale always in the next 3 decades come from liquidity and store of value function, the dollar will stay dominant. I have no doubt about that. If scale effects may come from network effects linked to digitalization, I think China has a good chance to displace the dollar because China will have huge network effect in its area for the digital payment system. So ultimately for me, the question whether China, the renminbi will displace the dollar or not is a question of the nature of the scale effect. And that goes back to the question.
Thank you.
Yes, thank you. One question and one comment. So the question is on your comments at the very end in terms of the timeline. So we had a great discussion here last semester with the current fellow in residence from the US side, talking about how basically China is 3 or 4 years ahead in the development of their digital currency. Now the US is really catching up, putting a lot of effort into it. I was wondering, so in my mind, basically it's like China 3 or 4 years ahead of the US, 3 or 4 years ahead of Europe. Do you think that's accurate? So what do you think is a realistic time horizon for digital euro from your vantage point? And then the comment, I think, the comment on the payments and convertibility side, I would just like to push back a little bit because basically today, you know, you can get a credit card from Coinbase that would allow you to essentially pay with your crypto, with your Bitcoin or Ethereum. You have obviously mass market adoption with, you know, Tesla, at least for some time, accepting Bitcoin. eBay is considering accepting cryptocurrencies. So just to make the point that the landscape is shifting. And I think within certain ecosystems, crypto already today functions as money, right? If you are in some metaverse, you would not be able to pay with dollar or euro. You have to have the currency that metaverse operates in. So just to push back a little bit there also in terms of the definitions.
Okay, these are 2 questions which are actually related to the technology, right? So the first one, the one thing I should have said is whether Bitcoin will survive, whether Ethereum will survive, whether all those sort of strange animals will survive, even Libra. They have done us a great service. Because in the field of retail payments, nothing was happening. Innovation was sleeping. And now everybody has woken up to the sort of gaps in our retail payment system, especially cross-border, especially remittances, especially interbank, right? So you've seen in the last 3 years flourishment of public initiative because private innovation has led the way. And this was happening in China. China, there was Tencent and non-financial, and the central bank is running after them to catch up. That's exactly what's happening. So for me, if we were in a business school, I would see that as perfect business case of innovation, driving competition, driving innovation. It's fantastic. So whether China, so there's one question whether China whether the US can catch up with China. Well, that's a broader question. I'm not the most the most competent people to answer. In my view, there's a big question mark on the technology competition between China and the US. And this is a very fascinating question because it's a question between 2, obviously now competitive political systems. And which political system would be most conducive to technological innovation in the digital world. I have my opinions, but it's not founded. But for me, it's a fascinating topic of discussion between, you have a competition, technology competition between two big countries with very, very antagonistic political systems.
And the one thing I would add to that is just that you didn't talk about quite as much, which is completely understandable, but there's a different kind of competition than competition between companies and governments. It's governments and governments. The geopolitical aspects of like if China wants to try to drive the renminbi to be the reserve currency of the world, they're approaching it from a geopolitical perspective. And that's a different dimension and dynamic that may affect significantly how Jess has a question, and then I'll come back to you.
Because I think, you didn't mention now where Europe stands and when you think a digital euro is feasible, like within the next 5 years, 7 years, just,
I would say 5 years.
Okay, yeah.
I would say 5 years, yes. I would say 5 years. I think the challenge for Euro to be totally open is to put their regulatory act together. Now, you have, for those of us who are from Europe, you know that there are several regulatory silos affecting payments and which do not communicate with each other. So in the conclusion of our report with Markus, we said this kind of stuff, you have really to have a clear vision of what kind of payment and monetary. It's a great opportunity for it. We've been talking about capital union, market union for years. Now we have an opportunity to have a payment union. Because the dirty secret, I mean, it's not a secret, is that the retail payment system in Europe is operated by US companies. The cross-border payment system in Europe are Visa and MasterCard. That's the truth.
Jess.
It's actually picking up on that comment. I was really thinking about, I'm a former central banker myself, and really this middle line to me here, the threat of external and internal competition, is the area of most uncertainty, and to me it seems the most, for China perhaps it was very clear that in the short term there was a threat, and for the US and the UK, what I sense is that they both feel like there isn't a threat internally because they can control it by regulation, but maybe externally at some point in the future there's a threat. And yet central banks, I don't think are the best place to really evaluate this line. And that's one of the reasons I wanted to ask you is that maybe one of the reasons why a lot of the discussion around CBDC is framed around payments rather than wider monetary infrastructure?
Yes, I think it's very true that if people talk more about payment than money, it's because they don't feel the heat of competition, whether internal or external. So I'm over simplifying the US position, but nobody believes in the US that the US dollar is going to be challenged in the foreseeable future. So external competition is not an issue, and internal competition we will deal with regulation. So if you are in that situation, you may think, okay. So the unknown dimension is consumers. How will they react to that? How will they keep considering that digital bank money is equivalent to government money when you cannot convert it to anything? So that for me, it's a big question. And I'm not as optimistic as many US officials about cash, at least until recently. I still remember 3 years ago, I was transiting for New York, and I bought a packet of chips, and she would turn down my cash. She would not accept cash, and she asked me to pay with a card for what, $1.50. So that.
I do wonder how much events of the last literally week affect the role of cash if Russia can't access its foreign reserves in banks and has to ship gold to China to, I mean, yes. The gold is really heavy.
Yeah. Yeah. So I mean, we are venturing something, but three things about that. First, I was personally surprised by the quickness of the bank run in Russia. So I would not have expected it. So the sanctions have triggered the destabilization of the domestic banking system in Russia, which I would not have expected. Second, you need someone. In my view, that's the ultimate argument against pure private. You need someone to stand up when things go wrong and provide you the money you need. That is very important. I was half responsible for the cash cycle when I was at Banque de France. It cost us 2 billion a year for a country like France, medium-sized country, 2 billion a year, just to make sure that the cash cycle operates well, that banknotes are clean, that they're available. Ubiquity, cash money, public money must be ubiquitous. It must be available everywhere, every time. And I'm not sure that any private operator has the incentive to do that when things go wrong. So that's you have to get that kind of backup, and that's very important.
So I'm going to, I know we're close to the end. I'm going to channel my inner Jess and try to help her with a question here. You talked about privacy, and my take on privacy was different, and I may very well be wrong, but you think of cash as very private. Okay, but cash you have to go through a banking system. If it's more than $10,000, that gets reported. Whereas if you're doing digital cash on blockchain, it could be, go back to your original quote from Milton Friedman, like, the gangsters can use digital cash. If it's a blockchain, you don't know, it's a public ledger, but you don't know who sent it, and you don't know who's receiving.
Yeah. So what makes Bitcoin private or anonymous? It's not that it's on the blockchain, because everybody can watch a blockchain. It's because you have addresses. You're not there on the.
That's what I mean. You have encrypted addresses with no link to.
Yes, to your identity. So, but that can be regulated away. In my view, 10,000. Okay, I don't think we can expect to make private payment 10,000. But I used to say when I made a speech, let's say I promised my wife that I would quit smoking. Now, from time to time, I would sneak out of my apartment and buy a cartridge of cigarettes. I don't want her to know about that. And that's where privacy ultimately lies. Small payments, which you do in your life, that's your area, including to your family. Because you promise to behave and you don't behave as far as smoking is concerned. And cash gives you that. And
that's fair. That's fair. All right, so we're at 1 o'clock. I wanted to thank everybody for coming, especially those of you online. Thank you very much. And we will have more of these seminars over the next month or two. So
are there any study groups taking place?
Oh, and Claire is reminding me there's a study group tomorrow.
4 o'clock.
4 o'clock.
In Allison Dining Room.
In Allison Dining Room. Hopefully everybody knows where Allison Dining Room is, over in the Taubman Center. Central banks and climate change, which is a kind of hot topic right at the moment. So tomorrow, 4 to 5:30, Allison Dining Room, central banks and climate change with Jean-Pierre. So, thank you all for coming.